In this episode of Elixir Talks, we discuss what exactly is mortgage default insurance, when and why it is required to secure a mortgage here in Canada. We will also discuss on how the premium is calculated and what happens on default. As per law, Canadian banks can only provide mortgageability to consumers with at least a 20% down payment, unless the mortgage is insured against default. So, for high ratio mortgages where your down payment is less than 20%, you would certainly need mortgage default insurance. In some instances, if the home or property is in a remote location, the bank might require the mortgage default insurance even though your down payment is beyond 20%. This insurance also helps a buyer to get into building home equity sooner if they have less than 20% to contribute towards the purchase of the property. It is offered by multiple insurers, primarily by Canada Mortgage Housing Corporation, often called as CMHC, Sagen, formerly called as Genworth Financial, and Canada Guarantee Mortgage Insurance Company. Some finer points to understand this mortgage default insurance better. Let's review them. It protects the lending institution and not really the borrower. It's only available for homes which are priced under $1 million. Premium is calculated based on the percentage of the amount which is borrowed. The mortgage amortization cannot be longer than 25 years. And finally, the premium is generally back-end loaded, meaning that it is added to your mortgage principal and paid monthly over the amortization term. So it is not to be paid at once at the time of purchase. By the way, here you do have the option to pay the premium as a lump sum when your mortgage begins. Now let us look at how the mortgage default insurance premiums are calculated. This table gives you insight on the tiered rates on various loan to value ratios. The main thing which I want to highlight is that the premium calculation is at a tiered level. So a buyer who is doing 10% down payment will pay exactly the same amount of premium as a buyer who is doing 14.5%. This means that it is in our best interest to reach the maximum slab which we can within our means at the time of securing the borrowing terms with the bank. Let us now go through a couple of premium calculation samples to make it more clear. Scenario number 1, where purchase price is 600K, down payment is 10%, which is 60,000. Mortgage loan amount is 540K. Loan to value ratio here is 90%. Premium on the total loan amount is 2.4% of 540K, which is 12,960. Scenario 2, same purchase price with a down payment, this time 5%, 30K. Mortgage loan amount is 570K. Loan to value ratio 95%. Premium would be 3.6% of 570, which is 2520. It is seen that insured mortgages generally tend to have better rates for consumers than uninsured mortgages. Let us review on how it works when a consumer defaults on a mortgage with an example scenario. Suppose Rita and Trevor bought a home for 900K and their outstanding mortgage is 800K. With a change in their job situations, they cannot keep up with the mortgage payments and have defaulted on their payment terms. The market is going through saturation and the bank can sell the property only at 750K as a power of sale. Since the outstanding mortgage is 800K, the insurance provider pays out the remaining balance of 50K to the financial institution. Thanks for watching. If you like this episode, do like and subscribe for more such content and share with your friends looking to get into a mortgage and will find this helpful. Stay motivated and I will see you soon.